Bonds are simple, interest-only loans. It's that simple. Unlike a stock where little is promised, but the potential reward is unbounded, with a bond, everything is spelled out and you don't get more than that. If we draw it as a picture, we're going to expect interest payments over regular periods, but none of the principal is repaid until the end of the loan. When the borrower is a bank or credit union, these agreements are called certificates. When the borrower is a government or corporation, these are called bills, notes, or bonds, depending on the length of the loan. They have a face value, which is the amount you'll get back at the end of the term of the agreement, and a coupon, which specifies the fixed dollar amount that you'll receive every year as interest in either monthly or semi-annual payments. Bonds with longer terms or poorer credit ratings need to offer higher coupons to attract investors. The coupon rate never changes. This is the reason bonds, like CDs, are called fixed income investments. What makes these different from an IOU or loan or even a bank CD is that these are negotiable, meaning you can buy and sell these in a market for the current price. It's a competitive market, and that price is determined by the prevailing interest rate for similar bonds. There's only one day when the price has to be equal to the face value of the bond, and that's its maturity date. Interest rates move around daily. Today's interest rate for a 5-year Treasury note is around 1.5%. 30 years ago, it was over 15%. The credit rating of the issuer is very important. Many corporations with outstanding credit ratings also issue bonds to raise money. Corporations with weaker credit ratings need higher coupons to attract investors, so these are called high-yield bonds. Now, as always, beware the marketing. While high-yield certificates are good because they are government insured, high-yield bonds are bad, at least from our point of view that it's better to use high-quality bonds to stabilize your portfolio and keep your risk in the stock market investments. Because in addition to default risk, junk bonds tend to go south when the stock market tanks, exactly the wrong time. Now it's time for some fun. I'll give you 2 facts. You choose the fact that's true. Here's one. All bonds are subject to interest rate risk unless held to maturity. Here's the other. Bond prices vary with interest rates, but do not grow like stock prices grow. This is false. Interest rate risk, also known as price risk, refers to the risk that the price of a bond will fall due to an increase in interest rates. There are no exceptions. When interest rates rise and you have your money locked up in a bond, you are missing out on investing that money at the new higher rate. The bond you own is instantly worth less from the amount of your lost opportunity. It's a lost opportunity even if you hold the bond to maturity and get each and every payment as promised on time. This is true. Market prices for bond do not grow the way stock prices grow, but their prices do fluctuate with interest rate changes. The value of a stock reflects what people perceive the future profits will be for a company. So as a company grows, the value of the stock appreciates. Not so with bonds. A bond price and the current interest rate are directly connected, but the effect is not permanent. To see this, consider a 5-year Treasury note. If interest rates never change, the market price for that bond would remain flat every day for 5 years. But if interest rates went up 1% at the end of the first year, the value is immediately worth a few percent less. Still, that note will be worth exactly the face value on the very last day. And if interest rates fell, the opposite occurs. If interest rates fell an additional 1% every year for the life of the bond, the value of the bond might look like this. Intuitively, this is what you'd expect because your bond locked in higher interest rates than what's available on the market. But that ceases to have any additional value when the bond matures and is worth the face value. Now, can you see that the same size interest rate changes have a bigger impact on the bond price when the maturity date is further away? Bond prices move instantaneously in the opposite direction when interest rates change by a factor you can control called duration. Now I want you to see that if interest rates were to instantly rise by 1%, the price of the bond or bond fund with a 1-year duration would go down 1%. Down 1% causes a price rise of 1%. Longer-term bonds and bonds with smaller interest payments are more sensitive to interest rate changes because they have a longer duration. If the duration is 8 years, then a 1% change in interest rates causes the price to change by 8%. The primary point is that a bond price isn't merely influenced by interest rates, they are directly connected by math. We care about price sensitivity so we can invest in the appropriate type of bonds. We don't expect to get a return because of interest rate changes, because nobody can reliably predict interest rates. We're investors, not speculators, so we're more concerned with total return, which includes the dividends and reinvested dividends. Next, we're going to clear up the confusion about whether to buy individual bonds, bond funds, or bond ladders. That's coming up. Please give us a thumbs up if this video was helpful to you. And to subscribe to our channel, click here. Thanks for watching.